Okay, folks, so what'd you think about my scribbling last week about time value of money? No comments. Y'all have some kind of deal where nobody talks? Is that what this is? Just wait till I leave and then you have a big conversation. Well, all right. I have posted, I called Hewlett Packard and I got a tutorial from them on your HP 10B calculator. I've posted it. It's in Unit 3. Just got through doing that. And it's a pretty good little explanation of how to use that calculator if you don't like the way I try to explain it, or mine isn't complete enough. Anyway, so you now have a tutorial for that calculator posted, like I said, in Unit 3. Here's my plan, folks. I'm probably Thursday, I'm going to do another little whiteboard session. I'm going to go over bond valuation for you, because we're going to use the idea of this time value of money stuff to be able to value bonds. Matter of fact, a bond actually has two different streams of cash flow going at the same time. You've got an annuity. That's the coupon rate that pays every 6 months or year, depending on whether it's annual or semi-annual. And then you got the terminal sum, the $1,000 you're going to get back at the when the bond matures. So you have to use present value of an annuity and present value of a dollar to add those two things up, and that's what you would pay depending on the discount rate you're applying to the cash streams. And I'm going to get into all of that on this little whiteboard probably Thursday. And I'm going to do a couple of problems for you. Let's see. What am I going to do? I'm going to do 1512 and 1521 in your textbook for you. 1512 and 1521. And that's going to be on page 227 and 229. And then I'm going to post a problem. It's going to be just like the one you're going to have on your test, except obviously I'm going to use different numbers. The reason is that I want to make sure you understand all the attributes of a bond. Okay? For instance, almost all bonds are on a semi-annual basis. If the coupon rate says 8%, and we're talking about a par value of 1,000, and I'm going to explain all these terms Thursday. Anyway, if the par value is 1,000, 8%, you should get $80 a year. But if it says it pays semi-annually, which most bonds do, you're only going to get $40 a year. You don't get 80 twice. That's a misunderstanding. Okay? So what happens is when you go to a semi-annual bond, what you have is your in or number of periods doubles, and the interest rate that you're using, and there's two different interest rates. You got your current market rate and you've got your coupon rate. Both of those are halved or divided by 2, because those are both given to you as an APR, annual percentage rate. So we're going to do semi-annual bonds. We're going to have a call provision in these bonds. And understand a call provision is simply saying that, you know what, let's say I just issued a 25-year bond, okay? In 5 years, because you have a 5-year call protection, in 5 years, I can call this bond if I want to. It's kind of like if you've got a mortgage, you want to refinance it. Well, that's what this company's doing. They issued this bond, and right now they can get a lower rate, and they're going to see if it's worthwhile to refinance. So that's what a call provision is. But they have to give you what they call a sweetener or call premium, because if they're going to call this bond in 5 years, they're taking away 20 years worth of interest that you could have earned. Now, you're not going to lose money, folks, but you're going to lose potential income. Okay? That's why they do a sweetener or a call provision. And they might say, okay, I'm going to give you the call provision is 101 and 3/8. Then they're going to have to give you a little bit more than $1,000. So you're getting your $1,000 plus a little bit more in 5 years instead of waiting 25 for it. But remember, you're also giving up 20 years of interest that you could have earned. Now, what's the only reason they'd call a bond? Interest rates have dropped. So if you want to take the money that you're going to get from this, call premium and put it back into bonds, you're probably going to have a much lower rate of return, because typically they won't call a bond unless they can get about a 2.5% lower rate, somewhere in that range, depending on the maturity and the interest rate that they're paying on it, and the size of the bond issue. So they're not doing you a favor, folks. I mean, when you go in and refinance your home mortgage, are you doing that to help the bank? Of course not. Trying to help yourself. Okay? So that's number two. So number one, semi-annual bond. Number two, call provision. And number three, bonds are traded in 30/32 of a percent. 32nd of a percent. And here's the reason for that. Let's say you're talking about an $800 million bond issue out there for 25 years. Well, when you take 1/4% or even a 32nd of a percent change, that's going to affect significantly the value of that bond. That could be hundreds of thousands of dollars over the life of that time. So we're going to do, after I do these two problems for you in the book, and I explain everything, all these terms like call provision, current market rate, and all that wonderful stuff, we're going to, and this is going to give you, you're going to find 4 answers to a bond problem. The first answer is the present value of the bond. What would you pay for this bond? The maximum amount that you're going to pay. Okay. Number 2, current yield. The current yield is basically year in, year out, what are you earning on your money? Okay. The third thing is what they call holding period return. Normally that would be called yield to maturity, but we're not going to do that. We're going to do something called holding period return, because you're going to sell the bond before it matures. All right. Well, if you do that, you can't get yield to maturity because you didn't hold it till it matured. And then number 4, yield to first call. What happens if they call the bond? You're going to have to look at all 4 of these answers to determine if this is a good investment for you. Okay? And I'm going to give you a key on that. Matter of fact, I can give you the key right now if you want. We're going to be buying a discount bond. Most bonds are sold at discount, which means less than $1,000, because your par value is $1,000 for our intents and purposes here. Par is simply how much you're going to get when the bond matures, not what you're paying for it. Okay? So anytime, and you want to write this down, anytime the current market rate is greater than the coupon rate, the bond sells at discount. Anytime the current market rate is greater than the coupon rate, the bond sells at discount. It's automatic. That's because, why are you buying a piece of paper that says I'm going to pay you 8% when you could have gotten, say, 9% if you'd gotten into some other type of security of equal risk? A couple of reasons. Number 1 is this is guaranteed. You're going to get this risk or this rate for 20 years. Number 2, bonds are significantly better risk or less risk than other types of securities. You know, that 9% rate that was quoted to you might only be good for 60 days or 120 days. You've locked in your bond rate for 20 years. Okay? So, we okay so far? All right, but here's the thing. So somebody's going to tell me, well, gosh, you know, the heck with that. If my bond gets refunded, I'll just take that money and put it in equities. No, you're not. Because you're in bonds in the first place. Why are you in bonds in the first place? Less risk, normalcy of return. That's what you want. So you're going to take very low risk, pretty good returns, and stick them in the equities? It's up to you. I mean, are you going to change your risk parameters significantly? Most people aren't. And by the way, the older you get, if you're talking about personal investments, like me, the older you get, the less risky you want to be. It's automatic. Matter of fact, there's a nice little easy kind of rule If you're in your 50s, 50% equities, 50% fixed income. That's a bond, fixed income. If you're in your 60s, 60% bonds. If you're in your 70s, 70% bonds. The older you get, the less riskier you get because you don't have a whole lot of time left to recoup if you lose your money. Okay? Well, corporations think in the same way. You know what? A lot of people are going to be buying my bonds, but they're probably looking for some kind of guaranteed return over a long period of time with low risk. Well, that's why I get a AAA rating from Standard & Poor's and Moody's. Now, I understand I got some problems with Standard & Poor's and Moody's because they were involved in this bond fiasco, these mortgage fiascos a while back. But that's the best we got right now. So if you are in bonds and you get called, so they pay you off early, you're probably not going to get into equities. That's just the way it is. And by the way, in this full disclosure here, almost all of your U.S. Treasuries that have maturities of 10, 20, 30 years, they have automatic call premiums in them. They can call them anytime they want after 5 years. And a lot of people found this out to their dismay. People were buying these treasury bonds long-term, 30 years, back in the early 90s, and they were making about 10% on these things. Now, that's not bad because that's a risk-free rate. So let's jump on that. Well, they did. They put all of their retirement in this, or most of it. Okay, why not? Well, problem was they weren't disclosed by the people that were selling the bonds that, you know what, this stuff's got call premiums in it, call protections for 5 years. So around after 10 years, now they were making 10% on their money. They were just as happy as they could be. Well, here come the 2000s, rates have dropped significantly. Guess what? All those bonds were called. So these people that were making 10%, now they're making 4%. You just lost 60% of your income. Be aware, okay? That's all I'm saying. So anyway, what I'm going to do is I'm going to work these 2 problems here in the book, and then I'm going to put a full bond problem out there, just like the one you're going to have on your test. And we're going to be looking for those 4 answers, okay? And I'm going to give you a little key. You might want to write this down. We're going to be doing a discount bond. That means that their present value has to be less than $1,000. The current yield has to be greater than the coupon rate. The holding period return has to be greater than the current yield. And the yield to call has to be greater than the holding period return. It has to work out that way.
Jim, can you say all that again?
Yes, ma'am.
All down correctly.
Sure. The present value of the bond has to be less than $1,000. Okay. The current yield has to be greater than the coupon rate on the bond. The holding period return has to be greater than the current yield. And the yield to maturity, yield to call has to be greater than the holding period return. Okay, got it? So what I'm going to do is like I said, look at that tutorial. It's really pretty good. I was kind of impressed that it's posted in Unit 3, okay, for your calculator. Shows you all this wonderful stuff, how to use it, all the buttons. We're going to get into more buttons after the bond valuation. We're going to get into capital budgeting, where we're going to be talking about financial methodologies, how to value projects, okay? So, and you're going to be using time value money there too, but we're going to have to be figuring the present values, the cash flows, and things like that. But, all right, now let me make sure I got this right. So I will do that whiteboard for you Thursday, okay? And then we'll have our little normal Monday night meeting next Monday on the 1st. And then I will post your exam on Saturday the 6th and give you till the 9th. Is that right? That's how I got it from last week. And then you'll scan it and send it back to me. Is that okay? Now look, I'm not trying, there will be no tricks. You're going to have 3 problems on this test. Statement of cash flows, forecasting, and a bond valuation problem, like the one I'm going to put on the whiteboard Thursday for you. The full-blown bond problem. So this will give you a chance, for those of y'all that never talk, this will give you a chance to say something next week. Like, I don't understand what the hell you did, Harris, you know, and I can talk to you instead of everybody being muted here. All right?
Jim, I'd like to talk.
Yes, sir. Please do.
You just said the 9th on the return date for the test, but I think on Blackboard it says the 10th. I just want to be like totally clear.
Yeah, you're right, the 10th. You have through the 9th to take the exam, then you send it to me on the 10th.
Okay, thank you.
Absolutely. See, you can talk to me. It's perfectly allowed. I think we actually got more people here. We've got 15 participants. Normally we got 13. So welcome to my name's Harris. Glad to meet y'all. All right, so
Did you have a good spring break?
I'm sorry, what?
Did you have a good spring break in Texas?
Yes, I did. And I took my wife to the casinos over in Lake Charles. She had fun. I was doing okay, and every time I'd come over, she'd say I lost some more money, so I'd give her more. I ended up, I think, getting a little bit ahead, but she had a good time, so that was all that mattered. Yeah, great weather. Hated to come back to the snow, but you know, what do you do? Oh, and I finally got my Escalade. They shipped it up here when I wasn't here. Isn't that great? Oh, God. So anyway, here's my problems. I'm just worried about everybody on the same page with me now on this stuff. Good, because this is going to work out good. I'm going to do all this whiteboard for you. And then if you got any problems at all on any of the 3 problems, not just the bond problem, next Monday night's the time to hit me with it, because you don't have another shot at it, okay? Before you take the test. Promise you, no tricks. It's not what I'm here for. And then we'll get into project analysis with net present values, internal rates of return, and marginal rates, modified internal rate of return stuff. What do you think? Any questions? Concerns?
I have a concern, Jim. You're buying Escalades and gambling. Are you sure you have a doctorate in finance?
Well, I told you the normal person would be worried about risk. I don't care. I got a pretty good deal on that thing. They had a deal where if I got it before February 28th, they'd knock $8,000 off, and if you financed it with GM, what's left, they would give you another $2,000, and then they offered me a really good amount of money on this stupid Tahoe I had that I bought really good because the guy I bought it from before I moved here was the major owner in a Chevrolet dealership, and he'd used it for about 2 or 3 weeks, put 3,000 miles on it, sold it to me for a demo, you know, and it was a $76,000 truck, and I got it for 62, so I wasn't complaining. And they gave me $42,500 for it, so that's not too bad. I didn't do too bad on it, and they didn't deliver it for a month after they set the financing up, so they're going to make the first payment on it. They didn't like that. But be careful because they're really good at curtailment scams. The one I bought my wife, it was an XT5. She wanted one of those little ones. Okay. Anyway, I went in there, traded in a car, bought that one. And I was looking at the closing statement and I'm saying, wait a minute, I traded in a car that I paid a lot more sales tax on than this car. You owe me the difference. Oh, yeah, we forgot about that. $1,400. They were going to put that in their pocket. This is the kind of stuff you got to watch out for with these guys. You know? I hope nobody hears a car salesman. It was the F&I people, the finance and insurance, that were trying to get me on that deal. But anyway, back to our course. Any problems? All right, so next Monday, though, if you have anything, that's when to hit me with it. And I'll do my best to be as straight up with this explanation and these little numbers that I'm going to do for your 3 bond problems as I can, okay? And look at that tutorial. I think it'll help on your calculator. No other problems. Y'all just ready to go watch TV, huh? Okay.
But if I say something about that?
Yes, sir.
At least for me, with all this stuff, I'm still trying to grasp all the general concepts throughout all the chapters.
Mm-hmm.
So when I'm in class, there's not anything specific that I'm struggling with. But I think just going over the terminology, having some sort of structure or direction in the class beyond just what questions did you have would help.
Okay. I'm not sure exactly what you want me to do on that, but I'm willing to go any way I can to help you.
I think
Okay, go ahead.
because I can back that with Mark too, because I'm the same way. There's so much content being covered in the chapters that, you know, doing one problem out of it and watching you do it on the board is great, but I don't know, I get a little lost on the terminology and just understanding what exactly it is that's going into all this. I'm a very visual person and I like to know, okay, so, you know, this term means this, and in our industry, this is what we should be expecting out of that, as opposed to just arbitrarily, hey, this is a company that this was their, and I'm having a brain fart right now. I can't think of any specific terms at the moment, but you know, there's just so much going into each problem that it's hard to grasp that, and it's hard to reiterate that as a question when I don't quite know what it is maybe I'm not understanding.
The problem we got is y'all didn't get accounting, economics, and statistics first, because they had to put this thing together pretty quickly. And normally you would have those 3 classes before you would take the finance class. So you missed a lot of the terminology. What I'm trying to do is show you, I'm trying to explain the important terminology parts of it and show you how the numbers work, because I've got a lot I got to get done. Well, you can see the size of the book. This is, obviously, we're not going to get all these chapters in this book covered. I'm trying to hit the highlights, the stuff that you're going to need or you would normally get a introduction to in a standard MBA corporate finance class. That's what I'm trying to do. May not be doing a great job of that, but that's what I'm trying to do, because I only have so much time to do this stuff with. And we got to get, after the bond valuation, we've got to get the financial methodologies, and then capital budgeting, and then cost of capital. And then I'm going to try to do enterprise valuation for you to show you how this stuff works on the value of the corporation. And that's pretty much all I've got time for. So I will try to do a better job Thursday on terminology and how it applies to specifically to this bond valuation. You understand why we're even doing this. If you're a corporation and you need to have some additional capital. Well, you're going to issue bonds or you're going to issue equities. And we're going to get to equities later. But a lot of them, because of the fact that you're talking about, this situation where the more stock you throw out there, the smaller the piece of pie is for each of your stockholders when you're doing dividends. And dividends aren't tax deductible to the corporation. They like bonds. They like debt. That's why we're doing this first. So this is a premier way for a corporation to get additional capital for expansion, new product development, R&D, whatever. This is how they do it. That's why I'm trying to throw this out there, because let's say you need $600 million. Great. Well, how many bonds are you going to issue? What would be a good price that people would jump on it, and rate of return? And because you're selling at a discount, how many bonds you're going to have to come up with? If you're talking about, my bonds are going to be $100 a piece, I need 600 million, but you're selling them at, say, an 8% discount. Well, how many bonds do you need, and why 8%? Why not 9? Why not 7? That's what this is about. Does that make sense?
I don't know if this helps anybody, but what I've been doing is while I read the chapters, follow on with the companion site and the Excel sheets that they give us on there. And it kind of lets you manipulate the numbers and see what things do, like how it affects the formulas without going through all of the calculator buttons and all that tediousness. I don't know if that helps anybody. It's helped me at least to better understand the formulas for sure.
I would agree. I actually just tend to make the formula in Excel to totally be able to manipulate and fill in. But that was leads to a good question though. I mean, it sounds like some of us are using Excel to do a lot of the problem solving. Some people are using the calculators for the test. When you say scan it in, what specifically are you looking for? Is there written explanations to our answers? Do we need to show work using what buttons we push, or if we're using Excel, how are you? What's your expectation for the test?
I don't want any written explanation. I want to see the numbers. So if you use a calculator, what buttons you pushing? If you're using Excel, okay, show me the cell formulas that you're coming up with. That kind of stuff. I just want you to be able to show me the steps that you took to get your answer. Okay?
Can we do it in the format that you show in your videos?
Absolutely.
Because I personally love how you do that. It makes complete sense that way.
Sure. Matter of fact, I found, I've been doing this for 30 years, and I found out that that's the best way to try to get this across. It seems to work, and I think this tutorial, if you look at it, will help even more. But yeah, that's fine. And not only that, I want to see all the buttons you're pushing or your cell formulas, because see, let's say you make a small little mistake up front, but you carry everything else right after that, but you're carrying the wrong number. Well, you're only going to lose a few points. I'm not looking for bottom line. I'm looking for structure. And if I can't find out, if you just give me an answer and it's wrong, well, that goes 25 points. See? If I can see what you've done the whole time, and I say, oh, okay, there's where you made a mistake, all right, but you did everything else right after that, even with the wrong number, I don't care. You're only going to lose a few points. So you're helping me help you. Plus the fact, if you just give me an answer, I have no idea what you did wrong, so I can't help you. I can't tell you what you did wrong. But this way I can.
So for example, with the assets and the liabilities and the financial forecasting problem you did, do you want us to just write out all the different columns like you did, or do you want us to do that and put underneath how we got some of the numbers using adding the one number to another number to get a certain number and write all that underneath it? Or
No,
is just showing the sheet?
You don't need to write all that. What would be great is just go ahead and draw little arrows. That's fine. Say when you're talking about the first time you do the through the income statement, you get your net income. Then just draw a little arrow right over there and say, all right, I'm going to add this to retained earnings. You don't have to say it. I'm assuming that's what that arrow is about. That's why I was drawing the little arrows, trying to show you where everything went. Now, I don't need any written stuff here, okay? It takes a while to grade them because I'm trying to track everything to make sure where's the structure, where did you make a mistake if you made one at all. Does that make sense? Okay. Anything else? Well, I will post this thing Thursday. These 2 bond problems from your text, and then the one I'm going to make up that's going to be just like the one on your test. And as I'm doing this, I'm going to explain all these little steps here, and then and try to do all the terminology steps. And if you want to do your bond problem or anything else like I do on these whiteboards, that's fine. That's great. Okay. All right. Well, I will post this for Thursday, and I'll see y'all next Monday, unless you want to get up with me before then. You got my cell phone number. You got my emails. I'm around. Okay? All right.
Jim.
Thanks,
Okay.
Jim.
Thank
Okay.
you.
Sure. See y'all.
Thanks,
All right.